What if I told you that the biggest threat to your money right now isn't a crash, but something much quieter? Here's a shocking fact. The average dollar today buys 40% less than it did just a few years ago. Most people still don't fully understand why. Another one, every major financial reset in modern history didn't. Start with panic. It started with calm, with meetings, with pauses, with words like temporary and under control. So let me ask you a question. What usually happens right before the rules of money change? I've lived through multiple market cycles. I've seen times when people felt safe right before things got expensive, and times when everyone was scared right before assets quietly took off. And what I've learned is this: by the time the headlines scream, it's already too late to prepare. Right now, something subtle is happening behind the scenes with the Federal Reserve. It's not dramatic, it's not flashy, but it matters. And if you understand what comes next in this cycle, you put yourself ahead of millions of people who are just reacting. This isn't about fear, it's about awareness. Because whether you're saving, investing, or just trying to keep up with rising costs, what's coming next will touch your wallet, guaranteed. Stick with me because by the end of this video, you'll see the bigger picture most people are completely missing. Most people think the Federal Reserve controls the economy simply by setting interest rates, but that's only the surface level explanation. And honestly, the least interesting part, the Fed's real influence comes from liquidity. How much money is actively flowing through the financial system? I like to explain it this way. Interest rates are the brake pedal, but liquidity is the fuel in the tank. You can tap the brakes, but if fuel keeps pouring in, the engine doesn't really slow down. That's why markets and prices can keep rising even when rates are high, and why focusing only on rate cuts or hikes misses what's actually driving long term inflation and asset prices. When money is easy to access, people borrow more, businesses expand, investors take risks, and prices, especially for assets, move higher. When money gets pulled out, everything tightens, often very quickly. I've watched this cycle repeat more times than I can count. And every time, most people are arguing about small rate changes while completely ignoring whether money is being added to or removed from the system. Liquidity doesn't come from everyday people suddenly spending more responsibly or saving less. It comes from the relationship between the Fed, major banks, and large financial institutions. When the Fed wants to stimulate the economy, it makes cash easier for banks to access. When it wants to slow things down, it quietly pulls that cash back. And here's the part that confuses people. These changes don't show up at the grocery store and rent prices right away. There's always a delay, sometimes months, sometimes longer. That delay is why people are told inflation is cooling while their cost of living still feels brutal. The system moves slowly, but when the impact finally reaches everyday life, it hits all at once. For the past few years, the Federal Reserve has been quietly doing something most people never noticed. It's been pulling money out of the system, and this process is called tightening. And it's basically the Fed saying things are getting too hot. We need to cool this down. But here's where Section 3 really matters. That tightening phase is now ending, or at least pausing. And that shift is a big deal, whether people realize it or not. When tightening stops, it doesn't mean relief shows up overnight, and it definitely doesn't. Mean everything suddenly becomes affordable again. And what it does mean is that the pressure that was slowly squeezing the system is no longer increasing. From experience, I can tell you this is usually the moment when the tone starts to change, not loudly, not dramatically, but subtly, historically. This pause tends to happen when something behind the scenes starts breaking or when stress quietly builds where the public can see it yet. The Fed rarely waits until damage is obvious. They move when the risk of more damage becomes uncomfortable, and once tightening stops, the next phase in the cycle is almost never nothing. It's usually a holding pattern, followed eventually by easing, not immediately, not tomorrow, but directionally. That's the path. And this is why markets often start moving before official announcements make headlines. Investors and institutions aren't waiting for confirmation, they're watching the sequence: tightening, pause, stabilize, then stimulate. I've seen this pattern repeat across multiple cycles. And the mistake most people make is assuming that today will somehow be different. The end of tightening isn't the finish line, it's the pivot point. And pivot points are where the biggest financial shifts usually begin. This is where a lot of people get tripped up because when they hear phrases like money printing, they imagine stacks of cash rolling off a machine. That's not how it works anymore. New money is created digitally and it enters the system in a very specific way through large banks and financial institutions, not through everyday people. So when the Fed wants to add liquidity, it doesn't hand money directly to the public. Instead, it buys financial assets, mainly government bonds, from institutions that already hold massive amounts of them. In exchange, the Fed credits these institutions with newly created dollars, just numbers on a screen, but those numbers are very real. Suddenly, banks are flush with cash, and once that happens, that money has to go somewhere. It doesn't sit still. Banks are incentivized to lend it out through mortgages, business loans, credit lines, and financial markets. That's how new money slowly leaks into the real economy. And here's the key insight most people miss: almost all new money is born as debt. Every loan creates new dollars, and every dollar comes with an obligation attached to it. That's why lending is so critical to how this system functions. If borrowing slows down, money creation slows down. If borrowing accelerates, money expands quickly. I've seen firsthand how people underestimate this dynamic. They focus on government spending or stimulus checks, but those are just the visible part. The real expansion happens quietly through balance sheets and lending incentives. And by the time the average person feels it, through higher prices, asset inflation, or cost of living pressure, and the process has already been underway for a long time. Understanding this is crucial because it explains why money feels abundant for institutions long before it ever feels abundant for you. This is the part of the cycle almost no one talks about: the lag. Before inflation ever shows up in your rent, groceries, or insurance bill, it shows up somewhere else. First, it hits assets, stocks move, speculation increases. Certain markets start feeling hot again, while everyday life still feels tight. That's why people get confused. They hear that inflation is easing, but at the same time, they see markets rising and prices refusing to come down. From experience, I can tell you this phase is the most deceptive. It creates a false sense of stability. Things don't feel great, but they don't feel urgent either. And that's exactly when the groundwork is being laid. New liquidity doesn't immediately raise the price of milk or gas. It first flows into financial assets, lending activity, and risk taking behavior. Only later does it spill into wages, consumer spending, and finally, higher prices across the board. By the time inflation feels obvious again, it's already baked in. I've watched people wait for confirmation before adjusting their finances, and that's usually when options start shrinking. This delay is why policymakers can confidently say inflation is under control while households still feel squeezed, and why those statements aren't technically wrong, just incomplete. The system moves in stages, not all at once. First, optimism returns, then borrowing increases, then demand picks up. And only after all of that do prices start climbing again. And if you understand this sequence, you stop being surprised. You realize inflation isn't an event, it's a process. And processes don't announce themselves loudly. They creep in while most people are still waiting for clear signs that already passed months earlier. At the heart of all of this is a trade off most people never agreed to, but everyone lives with: economic stability versus purchasing power. When things start slowing down, jobs weakening, businesses pulling back, growth stalling, policymakers are faced with a tough choice. Do they allow a recession to fully play out, knowing it will be painful and politically unpopular, or do they step in and try to stabilize the system, Even if it slowly chips away at the value of money, history shows they almost always choose stability. And I don't say that as a criticism, it's just reality. The problem is that inflation becomes the quiet solution. It doesn't feel like a tax at first, but over time, it quietly reduces what your savings, your income, and your purchasing power can actually do for you. I've seen people do everything right, save consistently, avoid risk, stay disciplined, only to realize years later that their money didn't stretch nearly as far as they expected. That's the hidden cost of protecting the system from sharp downturns. Inflation spreads the pain out slowly instead of letting it happen all at once. And because it's gradual, most people don't react until the damage is already done. This is why asset owners often feel fine during these periods, while savers feel like they're falling behind. It's not because anyone is cheating, it's because the system rewards participation over preservation. Understanding this trade off changes how you think about money. You stop assuming stability means safety and you start asking a better question: is my money actually keeping up or just standing still while prices move ahead of me? When people say the system is rigged, what they're usually reacting to isn't a conspiracy, it's an incentive structure they were never taught to understand. The financial system quietly rewards people who know how to navigate it and penalizes those who don't, often without them realizing it's happening. Fees, interest, penalties, and missed opportunities don't feel dramatic in the moment, but over time they create a massive gap. And I've watched this play out again and again. Two people can earn similar incomes, live similar lives, and yet end up in completely different financial positions. Not because one got lucky, but because one understood how the system works and the other didn't. High interest debt, late fees, bad loan terms, and overlooked benefits quietly transfer money from people who are stretched thin to institutions and to more financially savvy users. Meanwhile, those who understand credit, cash flow, and incentives often pay less, borrow cheaper, and get rewarded for behavior others are punished for. That's why asset owners, disciplined borrowers, and informed consumers tend to weather these cycles better. It's not that they're immune to inflation or downturns, it's that the system cushions them first. This is the uncomfortable truth most people don't like hearing. Knowledge itself is a financial advantage. And the gap isn't created overnight, it compounds slowly, just like interest. Once you see this, it stops feeling personal and starts feeling structural. And that's empowering because systems can be learned. You don't need insider access or massive wealth to benefit, you need awareness. The moment you understand how money actually moves, you stop playing defense and start positioning yourself intentionally, even in an unfair game. When a system feels uncertain, the smartest moves are rarely dramatic. They're practical, flexible, and boring in the best way. So, this is where a lot of people go wrong. They think preparation means making one big bet or chasing whatever worked last time. In reality, it's about building room to breathe. The first priority is liquidity, not as an investment, but as insurance. Having cash available gives you options, and options are power in unstable cycles. I've learned the hard way that being forced to act is almost always more expensive than choosing when to act. At the same time, not all debt is equal, high interest. Consumer debt becomes a trap in periods like this, while discipline, manageable obligations can actually increase. Flexibility if income stays stable. The goal isn't to eliminate risk entirely, it's to avoid risks that compound against you. Beyond that, owning assets that either produce income or historically hold value during monetary shifts can help offset the slow erosion of purchasing power. That doesn't mean chasing hype or timing tops and bottoms. It means understanding why you own something and what role it plays. I've found that people who survive these cycles best aren't the ones making bold predictions, they're the ones staying adaptable. They keep their expenses under control, avoid locking themselves into fragile situations, and leave space for opportunity. Preparation isn't about fear, it's about positioning. When conditions change, the prepared don't panic, they adjust. And that alone puts them ahead of most people who are still waiting for certainty that never comes. One of the biggest problems I see, especially during times like this, isn't massive financial mistakes. It's small leaks that quietly drain people month after month. They don't feel dangerous, which is why they're so effective. Subscriptions are a perfect example. Streaming services, apps, memberships, delivery perks, charges that barely register on their own but quietly add up to hundreds, sometimes thousands, a year. I've gone through my own statements and caught things I forgot I was even paying for. Another leak is frictionless spending. Tapping a phone or clicking buy now removes the mental pause that used to come with handing over cash. When spending feels painless, it becomes careless. Then there's statement blindness. People avoid reviewing their bank and credit card statements because it feels tedious. But that's exactly how fees, duplicate charges, and even fraud slip through unnoticed. I've seen people lose money for months simply because they didn't want to scroll through a statement. Buy now, pay later is another trap that looks harmless, but encourages people to spend tomorrow's money today. It feels manageable, until multiple payments stack on top of each other. And finally, there's mindless convenience spending, food delivery, impulse purchases, small treats that feel earned. None of this makes someone irresponsible. It makes them human. The problem is these leaks become more damaging during inflationary periods. When every dollar already buys less, plugging them doesn't require extreme discipline. It just requires awareness. And once you fix the leaks, money suddenly starts working harder without you earning a single extra dollar. Another angle most people overlook is how habits, not expenses, quietly decide their financial outcome. It's rarely one bad choice. It's repetition without awareness. I've noticed that when money feels tight, people paradoxically stop paying attention, almost like avoidance becomes a coping mechanism. They don't want to look at balances, statements, or budgets because it creates stress, so they delay it. But delay is expensive. Small recurring behaviors, rounding up purchases, ignoring price increases, renewing services out of convenience, and slowly normalize higher spending. What really accelerates this is lifestyle drift. Income goes up slightly, and without realizing it, standards adjust upward too. Better phone plans, nicer cars, more convenience, more deserved upgrades. None of it feels reckless, but collectively, it locks people into higher fixed costs. I've seen people trapped not because they spend wildly, but because their monthly commitments leave no room to adapt when conditions change. Another quiet mistake is failing to renegotiate insurance, internet, phone plans, even rent. Many of these costs are negotiable or shoppable, but people stick with them because switching feels annoying. Companies rely on that inertia. And then there's memo accounting, treating bonuses, refunds, or side income as extra money instead of real money. And that mindset leads to instant spending instead of strengthening the foundation. The common thread here isn't irresponsibility, it's autopilot. The system thrives when people stay disengaged. But once you pause, review, and question where your money is actually going, something powerful happens. You regain control, not by cutting joy or living miserably, but by making sure your money is aligned with your priorities instead of quietly working against you every single month. At this point, the most important shift isn't predicting what the Fed will do next, it's changing how you think about preparation. I've seen too many people obsess over headlines, meetings, and forecasts, convinced that if they just time things right, they'll be safe. But certainty almost never shows up when it's useful. The people who navigate these cycles best aren't guessing the next move perfectly. They're building resilience ahead of time. Preparation beats prediction every single time. That means structuring your finances so you don't need perfect timing to survive or even do well. It means having flexibility in your budget, breathing room in your cash flow, and the ability to adapt when conditions change. Markets will move, policies will shift, narratives will flip overnight. That's normal. What isn't normal and what usually causes stress is being overexposed, overleveraged, or locked into decisions that only work under perfect conditions. I've learned that Calm confidence comes from knowing you can adjust, not from believing you've figured everything out. When you're prepared, volatility feels less threatening and more like information. You don't panic, buy, panic, sell, or freeze. You observe, you adapt, and you move when it makes sense for your situation. That mindset alone puts you ahead of the majority of people who are still reacting emotionally to every new data point. The goal isn't to outsmart the system, it's to stop being surprised by it. And once you do that, financial decisions become clearer, steadier, and far less stressful. No matter what cycle we're in, as we wrap this up, the goal isn't to turn you into a policy expert or have you obsessing over every Fed meeting on the calendar. It's to help you see the direction of the system without getting lost in the noise. You don't need to track every data release, just a few big signals. Watch whether money is becoming easier or harder to access. Notice whether borrowing is being encouraged or discouraged. Pay attention to whether the conversation shifts from fighting inflation to supporting growth or protecting jobs. Those language changes usually come before financial conditions change in real life. But just as important, don't let monitoring turn into paralysis. I've seen people consume endless information and still fail to act on the basics. Awareness is only useful if it leads to calm, intentional decisions. You don't win by predicting every move perfectly. You win by staying flexible while others are emotionally whiplashed by headlines. That's the real advantage. If there's one thing I've learned through multiple cycles, it's that money rewards patience, discipline, and preparation far more than urgency or fear. The future doesn't arrive all at once. It unfolds slowly, then suddenly. And when that suddenly moment arrives, the people who prepared quietly are the ones who feel steady instead of stressed. My hope is that this video helps you zoom out, connect the dots, and feel more grounded about what's ahead. Not scared, not rushed, just informed. If this gave you a clearer perspective, let me know. And if there's a specific part of this system you want broken down next, that's where we'll go. If this video made you pause and think differently about money, tell me one idea that stuck with you. I read every comment, and your perspective matters here. If you want to go deeper, watch the previous video on your screen right now. It connects perfectly with what we talked about today. We put a lot of time, research, and real experience into these videos. So if this helped you even a little, support the channel by subscribing. It's just one click, but it helps us keep making content that actually prepares you, not scares you.